We're back. We're here with Dick DeFreitas. He is part of the Chelmsford Business Association. He's a member of the Board of Directors, here to discuss tax classification here in Chelmsford.
Yep.
Thank you for coming on, Dick.
You know, I've studied tax classification since 1991. That's 28 years. And I want to talk about two things. I want to talk about fairness, and then I want to talk about long-term tax policy.
Okay.
Just because someone starts a business doesn't mean they have a money tree in their backyard. Most businesses in town are locally owned small businesses, and they take pride in the community. Just look at the banners along the side of the road in Chelmsford Center and Vinyl Square and Drum Hill. You don't see an Apple or an Amazon among those. You see all small businesses. But small businesses, running a small business and meeting the payroll is a challenge. You know, I run ABC Payroll with my wife, and we're intimately familiar with the problems of our clients. Half of our clients are right here from Chelmsford. And when times are tough, the owners will say, "Don't give me a paycheck this week." They're the ones that don't get paid. So now you're taking, and people that are pro-classification saying, well, you can always write it off. Let me tell you about write-offs. If you have $10,000 you have to write off, what you gain is the tax on the $10,000. Nobody gives you the $10,000 back. It's just you don't have to pay tax on that amount. So I'd rather have the money than a write-off. You know, nobody's in business to collect write-offs because ultimately it means they're losing money. A small business is a pyramid on its point, and it has to balance very gingerly. Now, I'm going to give you an example of tax classification and fairness. And I'm going to use a Sarah Huckabee Sanders example like she gave when she was promoting the tax code. 6 people, and I use 6 because 1/6 is 17%, which is the amount of business revenue that we get compared to residential revenue. So 6 people go to a bar every week, and the bill comes to exactly $120 every week. So they divide it equally, and each person pays $20. 5 of those people are residents. The 6th person is a business owner. All of a sudden, the 5 residents decide, we only want to pay $18, so you have to pick up the rest. That means the 6th person now has to pick up their share, which is an additional $10, so instead of paying 20, he's paying 30, but they're saving 2. In Billerica, their tax revenue base for business is twice as much. So it would be like having 2 people that are business men in that group of 6. So you would only have to pick up 4 people would save each $2, but the 2 businessmen would each have to pick up $4. If you go to towns that are 50-50, then you assume 3 people are residents, 3 people are business owners, and the $2 saved for the 3 would be $2 paid by the business people. But guess what? Go back to the 1 in 6. Guess who's not going for drinks next week or the week after? If he has to pay $30 and they're paying $18, come on. Now, renters, you know, when I say businesses, and some people will say, well, it's the property owners. But as you know, people that rent, that have a business, have a triple net lease, which means you have to pay your share of the tax right away. So there's an unfairness there in that you're dumping this extra burden on 1/6 of the tax base, total revenue base, to give the residents will save a couple $100, but it'll cost these businesses thousands of dollars. And go back to the pyramid on its point. It doesn't take much to topple it over. I want to go to why it's a lousy long-term tax policy. We live in an integrated, dynamic time. Everything interacts. There are two things that create the tax bill. There's assessments times the tax rate is your tax bill. Now, everybody knows, or at least it's well known, that commercial real estate is worth more, well, it's assessed more than residential real estate. So for the same piece of property, the assessment is higher for a commercial person than for a resident. And property tax should be the same no matter who pays the bills. That's why it's called real estate tax. It's not called real estate owner's tax. Now, if you throw a third thing into the mix called classification, you create an elephant in a room. Now, all of a sudden, the first year, it's a windfall for the residents. But the elephant in the room is going to be noticed, and that's going to cause the assessments to drop because of the higher classification. If you classify at 50%, you go from 100% to 150, the assessments only have to drop 33% to get you to equal. If they drop by more, the residents get slammed. They have to pick up the burden. If you classify at 25%, the assessment only has to drop 20%. Now, it's not magic. I'm not playing magic with these numbers, and I'll give out my phone number if somebody wants to call me so I can explain the math. But it's the elephant in the room. You know, it's been said that, oh no, it's going to be a windfall every year. You'll get that savings every year. Only if the assessments don't move. But the assessments will come down.
Grab your mic.
The assessments will come down as you classify. So like I said, I've been studying this for 28 years. Every past selectman, I would say 99% of them, have voted against classification. The first tax classification committee meeting, I was on it, and Tom Moran and Sam Chase were very pro-classification. And they used to tell us to check our guns at the door so that we wouldn't get into an argument. By the third meeting, they had come around because they had visited the towns, talked to assessors, and got the relationship between tax classification and assessment, and they came to the conclusion it doesn't work. It only works the year you implement it, and then it slowly, within a year or two, gets back, I'm talking about the tax bill, to where it was before. So it's a lousy long-term tax policy. It's a better policy to bring more industry into town than it is to create this elephant in the room, because it gets noticed. It gets noticed by the value of the real estate. You raise the taxes, the real estate value is going down, and like I said, it only needs to drop a third to correct the 50% tax classification. So there's going to be a question on a ballot for people to vote on, and I read the question, and I think it's biased towards being pro-classification. People should really take a hard look and think about what I said with the numbers. There'll be a windfall for a year because you need time to adjust. Now, if classification is so bad, why don't the towns that have it switch back? Well, more than half the communities in Massachusetts, and I think the number is closer to 70%, I could be wrong, do not have classification, because they understand what I've just been saying. To take away classification would affect the residents negatively just for a year or two, and it's a big burden to place on them, so nobody wants to do that.
So
You know?
once switched,
Huh?
Pandora's box cannot be closed, right?
Yeah.
Is that what you're getting
Yeah.
at?
Mm-hmm. You open it up, and nobody has a political will to say, well, you're going to have to pay more money for a year because when we first put it in, you made money. You can't do it.
Well, tell people how they can contact you if they have questions about classification. One more minute for you, and then we got.
Okay. You can call me on my cell phone, which is 978-846-0033, after 10 a.m., please. And I'll be more than happy to go over the numbers. I'll be more than happy to meet with you. And I don't do emails. I wouldn't do emails for this because I would use the work email and I wouldn't do it.
All right. Well,
Okay?
it's a complicated issue, so hopefully people look into it, and we appreciate the information you brought forward, and thank you for coming on.
Okay.
Awesome.
Thanks for having me.
Thanks, Dick.
Sarah?